currency. And I'm sympathetic to the view that
hello and welcome to the program. Here we have live coverage of Fed Day, Fed decision
reacts very
coming up.
So they have to be careful about
Let's
how
take
they
a look,
calibrate
guys.
that when they
right now we got
put
the
their
S&P
STP
500 up.
together and what the
How
chairman
much,
says.
we just put a little comment up there saying inflation is cooperating with the Fed. How much? Really? A lot or a little?
I think it's cooperating a lot in that it's coming down. That's what they want to see. And people seem to have looked at the last number, and if you thought inflation was coming down, you pointed
Let's
to the
take a
half
look
of the
and see what's
indicators that
happening
said it
there.
was, and if you didn't think it was
Okay,
coming
we
down,
got
you
the
pointed to
S&P
the other one.
500
It
or
was
the
kind of one
SPY
of those
rather.
mixed reports.
Here's the QQQ. We're going to
So I
put this
think
on a
it's
5-minute
cooperating a
chart.
lot in that all they want to see is it's coming down. What
How
they don't
volatile it was
want
today.
is
I guess we'll go to
unhappy
SPY.
surprises of it going up. Now the big question is how
people
quick.
don't-
2-minute
people
chart.
don't seem to feel it coming down.
Well, that's true, but that's a different question.
It
The
is a
Fed
different
is trying to
question, but
steer
it's an important question.
It's particularly politically.
Yes.
Yes. Like, I don't think people are convinced that inflation is coming down. And also, people look at the level of prices.
For sure.
They don't recognize that if it's going up at a slower rate, that's victory. So what makes Jay Powell happy may
Here's a
not make
5-minute
Joe
chart.
or
We'll
Jill
take a look at
Sixpack
this for the
happy.
S&P
And that's a
500.
big political problem. But from the
It is
Fed's point of
slightly
view,
up
if inflation
0.16%
continues to come down
from yesterday's
gradually,
close.
the pace of the labor market slows a little bit, they can afford to be patient. What they have to worry about is that doesn't happen. And there's this other wrinkle about oil prices. If oil
S&P
prices are up,
500 did have a
headline
drop-off,
inflation is
but
gonna
look at
go
that nice
up.
quick
And
bounce.
the Fed wants to look through this, but they can't seem like they're not paying attention because, I have to buy gas. I don't buy core.
Not to get super wonky about this, but
Kelly Heaven. not to
So
get
is the
super
Fed going to
happy.
pause?
if only we
99%
really
chance
focused
say
on nominal
yes.
GDP, that would help clear up a little bit of the confusion, right? Because
Or are they gonna raise
the difference
hikes?
between the way
I
that
say they
energy implements
pause.
like a tax and maybe it's supply. The point
we'll have to
being,
take a
nominal
look, see
GDP
what
is growing at
happens.
almost 14% at the end of 2021. That 14% is an astronomical number. We're down to like 4%. So that just tells you how much potential we could really have for inflation and all the rest of it going
Right.
forward.
So, there are
We can also
economists who
trade
advocate
the
that Fed should have
trade
a
the
nominal GDP
SQQQ,
target.
which is
And I
an
think the counter
inverse
has been, it may be hard to explain to people. that
ETF
if-
for the Nasdaq. So if the
yes, because
Nasdaq goes
GDP
down,
gets revised
this
and all
goes
that.
up.
But I think
So
that
you're like
part of
shorting
this
the
is
market.
what do you use to steer the economy? And you want to look at things
SDS,
like nominal GDP.
which would short
and
the
then how do you
market,
communicate
for
with people in the markets?
S&P
And I think
500,
where the
which
Fed
is
has been
SPX.
successful in holding down inflation expectations
Wait, why is
by
SDS
suggesting
such a gap
a lot
there?
of
Look at that.
resolve to keep
Wow.
inflation coming down. And we, in a
That
sense,
don't
we're in
look
an
so good.
inflation targeting regime now. They don't talk about it that way, but that's what they're really
Haven't
doing.
we always been, or?
Jeez.
No, and when you and I started covering
That
this
was a
stuff,
big
people
drop
weren't
off.
so sophisticated about
strange.
inflation expectations. There was a lot of M2, and well, maybe not when you
Right. No, the people who still want M2 to come back. Still want M2
Odds
to
of a
come
soft
back.
landing,
Not
high,
gap
low.
down.
What do you
High.
say?
I think they're high.
High.
Yeah.
It'll be one of the rare times.
Well, anyway, let's
Well,
put the SPY up here.
Look, I think things
Take
are
a
breaking
look.
the right
SPY's
way. I'm
coming
not
up,
sure. I'm not
guys.
confident. I
Starting to
wouldn't, if I were the Fed, I
recover
wouldn't bet on it.
from this
But
little
compared to where
drop-off
it was
just
6 or 9
happened. We
months
are
ago, I
down
think
to
it's
that
much
here.
more likely.
David, thanks very much. Always great to see you.
Good to see you.
One of the treats of coming down here. David Wesley,
shucks.
Draw
Brookings.
a line here.
We are about 6 minutes away from the Fed decision and about 40 minutes from the chair's press conference. Our team coverage picks back up after this quick break.
See what happens here. So they're taking a break, I guess, right before the Fed comes out. Let's see if there's any other networks. Hey, look at that, nice recovery.
Back in 08, 09. So I think this is, look at the market reaction in the last 3 meetings.
Oh, what a
They've
nice
been
comeback
relatively
with S&P
positive.
for
And I think that's a
Nasdaq
good
and SPY.
sign. And I think, at the end of the day,
Wow.
if they do maintain their position at a steady state between now and let's say, June or maybe post Q1 of next year, the markets may end up faring well. I do see, unfortunately, a hang-up that may end up creating some problems in the markets, not monetary policy, but fiscal policy, because, I've been talking about in the last month, if we run into a budget
Your
problem,
big stocks are down.
or a
Amazon's
budget
down a little bit.
constraint or
Meta,
potential government
Nvidia,
shutdown
Microsoft,
in
Apple.
October,
We're all down about
that
a quarter of a
might be
percent to a
challenge
half
for the
a
markets
percent.
because you have to think about fiscal
So we'll have to
policy,
see what happens.
which
What's
is
up? Tesla's up.
counter offset
Almost 2%.
the tightening of monetary policy. We've been
Disney's actually up
running
1%,
budget
believe it or
deficits,
not.
quite
Bank of
large ones, by
America,
the way,
Palantir.
since COVID, and they're still growing. And I think that's one of the reasons the economy has done extremely well, and also the markets.
Yeah, and George, I think that's such a good point. I think
We'll
something
have to
that's
look
sort of
at that.
under-discussed is the
What a
fact that we do have
rebound
some key
for
debt
the
levels and
Q2
issues
and
we
the
work through
SPY.
as a country.
Yeah.
So we'll obviously be watching this Fed event very closely. Great breakdown, George Chillis, Senior Markets Correspondent here for the network. That does it for Alex and myself for Next Gen Investing for this Wednesday. Now coming up next, we do have the watch list with all of your live Fed coverage with Nicole Petalides coming up next.
My dad was a hard worker. He used to do side jobs, installing windows, charging something like $100 a window when other guys were charging $400 or $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
I'm Nicole Petalides, live from the New York Stock Exchange. Catch me on Schwab Network, available anytime, anywhere, any device, for free. Schwab Network.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab Network. It's time to look forward.
Find the next trend.
From every click to every tick.
John Bellows for longer, but the Fed stays where it is right now. We're near the end of the cycle.
You know, I actually think we're a little bit closer than what Stephanie just said. If you look at the inflation numbers, for instance, on the 3-month basis, they're actually much better than on the 1-year basis. And what that signals is that the more recent progress on inflation has been substantial. I think similarly for growth, we've had a good growth year, but more recently what we've started to see is some cracks in that. Housing starts this week was notable for having a big turn. So I think we're much closer in terms of...
So the decision's in. Oh no, we're still waiting?
I think we're closer.
What's going to be a pause?
What's
What's going to be interesting is what happens at 2:30 with the Fed, the meeting.
Interest rates
That's when things can get pretty shaky.
Forecasts unchanged because a lot of progress has been made. And that is proceeding carefully today.
Greg, what are you watching?
So, in the old days when I started covering the Fed, in the statement they had something that was called the bias or the balance of risks. And essentially what this was saying was even though we may not have changed rates today, what we're telling you is where we think the likelihood is of moving in the future. And that was in essence talking about whether they were more
guys
worried
always
about
want to think
inflation
about the
being a problem
future.
or more worried about unemployment being a problem. And essentially for the last few years, the balance of risk has been to tighten further, that all else equal, it was more likely that they would go again, that they would not go. In the last few weeks, I think, starting with Chair Powell's speech at Jackson Hole, we've seen the needle subtly move back towards, not quite, but almost to a neutral balance of risks. And I think that what I'm especially looking forward to the press conference for is to hear whether he ratifies the view that rather than being in the position of, we're going to raise rates unless the data says otherwise, I'm looking for a comment that effectively says, we're going to keep rates where they are unless the data says otherwise.
David Kelly, let's get a quick 20-second thought from you. You
Wow,
expect the
drop
Fed to
off.
sound hawkish, but maybe
That
act a
would be
little more
incredible.
dovish.
Yeah, I don't expect them to raise rates today, but I think you'll see one.
Look at that drop off,
still
guys.
say- the adults will still say one more hike this year. So I think the messaging will still be cautiously hawkish.
Wow.
I do think they should be done, and I think they probably are done because I do see some softening in the economy here.
That's very interesting. So you think they are done, but they will leave open the possibility of a move up later in the week. We are ready now to go for the Fed decision. And Steve Leisman.
the Federal Reserve maintaining its interest rate at 5.25% to 5.5%. But the committee continues trying to determine the, quote, extent of additional policy firming that may be appropriate. So there's this bias in the statement suggesting they're still looking to raise rates. And indeed, the average Fed forecast does continue to look for one more hike this year with an average forecast of 5.6%. Importantly, and I'll come back to that, there are 2 fewer cuts, 25 basis point cuts built in for next year. On the economy, economic growth was upgraded to solid from moderate. Job growth was said to have slowed, but remained strong. Inflation remains elevated, and the committee repeated its commitment to a 2% inflation target. The average forecast, let's get to the forecast for next year, now sees a 5.1% funds rate next year. That's up from 4.6%.
We'll put this on a 1-minute candle for you guys.
Higher for longer we've been talking about all morning here.
1-minute chart.
And just so you, if you want to do the math with their inflation rate, it's now only a half point of cuts built in compared to a full percentage point next year. The real rate actually goes higher next year. So the average Fed forecast sees itself getting tighter.
So I just ran a quick short position. That's what you heard. I already closed out of it.
So they have a real rate of 2.6 next year versus 2.3 this year. The funds rate is above neutral, by the way, all the way into 2026.
But
first of
you see how fast these
2026,
candles
they
are
have a
moving.
2.9% funds rate versus their neutral rate of 2.5%. The Fed more than doubled the GDP forecast for this year to 2.1 from 1% of the prior forecast to 1.5% next year from 1.1%. Lowered the unemployment rate for the next several years by about 0.3, so it doesn't see as much unemployment as it appears in the forecast. And it continues to mention the banking system, but not do very much with it. It says tighter conditions, credit conditions for households could weigh on economic activity, but the extent is uncertain, and it's all unanimous, guys.
Keep an eye on this.
All right, thank you very much, Steve. Stick around and as we bring back our panel, and we're also joined by Bob Pisani and Rick Santelli. Let me turn to you, Bob. What is the market reaction here seconds after the Fed releases its report?
Well, here's the effects of higher for longer and a little more hawkish here. So yields up. I see S&P just turned negative. Well, we were up modestly on the day here, and I think everybody wants some confirmation. Core inflation is turning lower, but what you see here is more hawkish comments on the economy. The economy is growing stronger than they thought.
Consolidating right here.
It was 1%.
As you see,
the estimate now is
consolidating right here.
Unemployment was 4.1.
1-minute
now
chart.
4.8. So
every
the
candle
economy is
represents 1
growing
minute time.
stronger than they thought. That's a little more aggressive,
you can see
we're seeing yields
now we're way down
spiking
here.
up here. I think the fourth quarter is going to be very, very hard to read. Everybody was asking me today about what are they going to say about oil's been up, yields have been up, dollar's been up, resumption of student loan debt. That's what people are talking about down here. So it's going to be very hard to figure out how to call what's going to happen in the fourth quarter because people are expecting the economy to slow down. But you sure didn't see it here from the comments from the Fed overall, guys.
All right, let's go out to Rick Santelli. Rick, what's your spin?
Well, it certainly looks to me like the higher for longer, I would sort of modify a bit. I would say holding here for longer. And that really describes it. And I think the reason they need to hold here for longer is because, like many of us, including the market, seen some very sticky inflation out there. And I disagree a bit that this is hawkish. Okay, I understand that you had 12 officials that see one more rate hike, 7 that see on hold. But I also see headlines here that job gains slowed. If there was one thing to say that would be meaningful coming from the Fed, it would be job gains slowed. And if you follow non-farm payrolls or you follow the unemployment rate, it certainly seems as though that is the case. And when it comes to the markets, look at what the 2-year note yield has done. It shot back up to 5.42. Look at what 10s have done, back to 4.36.
Let me give you a 1-minute chart here.
Many were taking solace in the fact that rates were down a bit today. I don't at all look at it that way. I look at it that the market's been tight, it's been orderly, and it's been rising. And yesterday, as I said on many refrains and choruses today, new cycle high yield closes, 2s, 3s, 5s, 10s, even 7s, except for 7s don't go all the way to 07 because they weren't around in 07. So we want to continue to see what the markets are saying. And why are the markets out of phase with the Fed now? when prior to this, when they were starting to raise rates and Fed funds were more in the 3s and 4% area, market rates were moving down
Consolidating.
because they really thought inflation would mostly vanish. But the stickiness of certain pockets of inflation, and you could say X, food, and energy, but those pockets are glaring and they bring a lot of eyeballs to the Federal Reserve. You could strip it out, but you can't ignore it.
See that.
Greg, let me ask you a little bit about the politics of the Fed here. In other words, so what they're saying about next year is very hawkish, right? They've said only 1 or 2 cuts instead of 3 to 4. Their median rate forecast is now 5.1 instead of 4.6%. How much of this is what David Weston just said, which is that they're afraid of letting the market get too far ahead of itself and getting excited about rate cuts? But do you think they're actually still going to do as many rate cuts as they previously thought was likely?
You really have to heavily discount any projection for what they're going to do more than a few months from here. They actually have no idea
You're
what they're
all
going to do.
VWAP in here for you guys.
I would say
Anyway,
that part of this, I'm going
price.
to guess, might have been internal Fed politics. There's a handful of members out there who have been talking about, they'd like to go one more time because they don't want to take any chances. And maybe the way you mollify them and get the unanimous vote that the Chair Powell got today is saying, we're not going to raise rates now, but we're going to tell people that we're not going to cut them as much. Now, when I look at the projections, you see an economy, and this is how he reconciles the very strong growth, very strong labor market that doesn't seem to be responding to the tightening they have to date. He says, okay, we think the economy is going to be stronger than we think.
10-year yields at 4.35.
All else equal, that creates more
overall
pressure on
market from
inflation.
yesterday,
How do we
the S&P's
respond?
down
We extend the period
0.11%,
of monetary
NASDAQ
restraint for
0.5%,
longer. This is
Dow
essentially
up
the trade-off. We don't need to go
3%,
higher, but we need to keep our
okay.
foot at least depressed on the brake for
now.
longer to keep the
60's
economy
down.
from running
Relative
ahead of its
strength of the
potential.
dollar
If
drop
we zero in on the last 3 months, though, we're talking about an economy with 2.4% core PCE inflation, adding about 100 and some thousand jobs a month. I mean, that feels to me like a very different picture than the one from 3 or 6 months ago that they might still be responding to.
You could tell two stories about the economy. You could look at the unemployment rate going up, as many of us do, and tell us that's an economy that's starting to grow below potential. Or you can look at the GDP numbers, which are 3% or plus for the current quarter, well above potential. And by the way, we'll get new revisions on Friday, and maybe the story will look very different. But I think that if you're the Fed, what you say is, even if the inflation numbers are doing what they're supposed to do, they're coming towards 2%, all of our models, all of our muscle memory says that good news on inflation cannot endure if the economy continues to run ahead of capacity. And therefore, we are not going to take a chance on that.
Let's take a look at this real quick.
Well, we don't feel like we have to raise them now and push the economy into recession, but this is an economy that, given the head of steam and the resistance thus far to tightening in train, says we need to basically maintain, again, the degree of restraint for longer than folks thought. And by the way, I think Wall Street might have been slow about this,
daily chart
but the bond market, we've seen 10-year yields moving up for some time. I think in some sense that was just, foreshadowing what the Fed just told us.
Stephanie Link, let me turn to you. Does this feel to you like a Fed that is close to done with this cycle?
Yeah, I do. I mean, I'm first and foremost, I'm glad that they paused. Not a surprise. They have risen rates 11 times, and plus they're doing QT, and they're going to continue to do QT, which doesn't get enough press in my opinion. So now we wait and we see, and we're now all data dependent. And the dates to keep in mind are on October 11th is the PPI number, and October 12th is the CPI number. Of course, we get the jobs number on the 6th. So we're all going to wait to see on that regard. I also thought it was interesting that they did revise GDP higher, and it's because we are doing better as an economy, much better than what most people expected. A lot of people at the beginning of the year, Tyler, expected us to be in a recession by now, and we're far from it with the Atlanta Fed tracker at 4.9. That number's going to come down, I know it, but at least we're above trend. And then finally, again, a reiteration of the 2% inflation target. He said it a lot at Jackson Hole, and they're recommitting to it again, and they're not going to come off that 2% inflation target. And we have a ways to go in terms of core PCE.
David Kelly, were these the hawkish sounds that you expected to hear out of the Fed?
Well, things are still consolidating in this area.
Forecast. I completely agree with Greg. They don't
we want to make a trade on that?
Next
No.
year. And what I'd say is this is not so much a soft landing forecast. It's really a soft landing scenario. If we have a soft landing, then they will only cut rates.
They've been talking about hard landings, soft landings.
A reasonable forecast.
For over a year now.
I take very seriously the drags that are
So when you
gathering.
think about it, almost a year and a half,
I think that higher energy prices, higher gasoline prices drag on the U.S. economy. I think the UAW
I guess
strike
we'd have to
is
say, yeah, a
troublesome.
good
I think
year
the
now.
possibility of government shutdown is troublesome. I think the effect of higher interest rates is
Well,
on
when
the
do they
banking system
decide to
on
descend?
lending. All of these things are
And
building
decide to
pressure on the
descend,
economy.
have a
So even
landing.
though the
Let's see,
third
it's gonna be
quarter's
hard
gonna
landing or soft
spectacular in
landing. Let's
terms
put
of
this
GDP
plane
growth,
down.
It's going to slow sequentially after that, and I think the Fed is
Stock
not out of the
market
woods in terms of
says-
having a recession in 2024, even though this forecast would suggest
There is no
recession in
landing
2024.
coming.
Go ahead, Greg, you want to jump in?
Yeah, there's one point I want to make is that we're going to hear from Powell soon when the press conference begins. And as you
Well,
and I
we'll just
talked about
drop
in the
down
past,
trying to
he
get
will
this thing
often
to come up.
sometimes push in the opposite direction of the sentiment that you get from the statement and the projections, right?
I'm asking the
What I'm going to
computer to do
listen
too
for very
much.
carefully is how does he talk about those out-year projections for the federal funds
Nasdaq's
rate?
down 0.5%.
When Chair Powell really wants to drive a point home and he thinks that the
S&P's
S&P,
only down
the projections are helping him
0.15.
that, he will align himself. He'll cite the
Oil, by the
projections.
way, guys, is
When
down
he actually wants to subtract from that,
0.75%,
he'll
down to
often say, well,
$90.53
that's not
a
necessarily
barrel.
a promise. It's just a bunch of people
That's
putting
pulling
numbers
back.
down. So does he align
it went
himself
as
with
high
that more
as,
hawkish out-year forecast, or does he play it
91.72
down? That's what I'm looking for.
John Bellows, jump
earlier.
in here. Your reaction to what's just taken place.
You know, a lot of our conversation has been about growth, and it does seem like the Fed has responded primarily to the better than expected
There we have it.
growth.
Look, the SPY's trying to come up.
Extrapolate the good growth that
It's
we've
holding
had.
this
You know, a lot
range.
of that has been for kind of very pandemic or post-pandemic specific
I was a
reasons.
little-
There's been a fiscal impulse on top of
I
that.
started to short
But those
this
aren't
since this
things that
candle
you can
happened as a
extrapolate
1-minute
forward.
candle.
So as you try and put your
So I was a
forward
little
thinking
short
on,
getting in
you know,
here.
you think you
I
need
think
to
I
take
got
into
it
account
here
the
when I
lags
entered
in
my short
monetary
position.
policy, the restraint from restrictive
And got
monetary
out
policy,
actually right down
and
here.
so I
No,
wouldn't
I got
wanna
in, I think it was right here.
overextrapolate
After,
growth.
it was,
So when
I
look
missed
at this
after the move.
forecast both for growth and
Happens so
for
quickly,
interest rates.
but anyway,
I'm a little bit
it is
concerned
what it
with
is.
over-extrapolating on the good growth we've had, and if growth
Hope
slows,
everybody
which,
that's
you know, I think
trading
there's a
the
reasonable
market
chance that
is
it will,
green.
I think the outcome could be quite different than what they've written down.
Steve?
I'm just a little afraid people might be missing a story here. I think the way to think about the Fed is in the context of
Let's
the
put this
real
on
rate
a
and what they're
5-minute chart here,
forecasting.
and we're going to
And
browse
that
a
real
couple
rate
other
shows that they are
stocks
tightening
here.
next year.
For an example,
I
let's
think
go to
this is a
Intel.
recipe for the Fed to be blowing
Well,
the
Intel, look at that,
possibility
they're
of a
just
soft
diving
landing.
down.
Greg is right. They don't know what they're going to do. They don't know what the
Google.
economic outcomes are going to be.
They
David
started
Kelly
down
could
today,
be
right
right
in
in
the
the
morning.
sense that a lot of these things gathering up
Apple.
could create softness. But the interesting
Down.
thing to me is the intention of
Microsoft.
the board at this point to maintain such a high
323
rate
low.
while they did not change their inflation outlook.
But it's not-
So
it's
they
not the
are
all-time
looking at
low,
a
as you
real
can see.
rate
We
that
still
is
have low down
more
here,
restrictive
312.
next year than it is this
Any
year.
good ones
I don't know
up
if
here?
that
Well,
speaks to
Tesla's
their
up
lack of confidence in their
1.68%.
ability to bring down
Look, they actually
inflation,
shot up
or what
after
that
the-
speaks
with the
to.
Fed
We may
hike.
have a chance to ask Chair
The
Powell
Fed
about
pause.
that. But the idea of the
Tesla
real
went
rate
nice
going
from
up and not going
267
down even a little bit like it was previously forecast,
273.
to me is worrisome and something
That was
that needs to
nice.
be watched by
The
markets.
real rate being the difference between what their expected rate of the federal funds will be
Here's
next
the
year
S&P.
versus the
Their
inflation number.
Right, exactly.
Versus core inflation. And that, not because they expect inflation to go
So
down
there we go,
very
S&P,
much, but it's because they expect
SPY,
rates to
Well,
stay
they
high,
do,
right?
coming
they do
back.
expect
Look at
inflation
that.
to go down, and they're not,
And
they're
the
not lowering
QQQ,
rates
I'm
as
sure
much.
is right. Yes, it's
and
behind it.
I'm curious to know what's behind that, but there is
Wow.
certainly in the forecast a turn towards hawkishness
This is the QQQ
in those
we're looking at
forecasts
here.
for the outlook for next year.
Very interesting, very interesting. All right, thanks to our panel, everybody. We appreciate it. Appreciate your time, and we are, of course, moments away from hearing from Fed Chair Jay Powell
We have about
himself, and
15
we'll get
minutes
some more
until his
reaction
meeting.
to the decision
He starts
from former
talking.
Fed Vice Chair Richard Clarida.
You can
after
either
a
he can
short
thank the
break.
market some more or raise it. So we'll see. They're on a live. Let's see what Schwab's got going on here.
Download the Schwab Network app and join us to follow all the market trends. Schwab Network.
Look, it's breaking down. Interesting. That's the QQQs. I'm gonna look at something here. Something's not working right here. Oops. A lot of volatility here. We're gonna wait for the Fed meeting. While we're at it, we'll have some little bit of music. We watch the markets. Five-minute chart here, daily chart, 1 minute chart. Here's where I can buy and sell. Wait for the Fed meeting. Yo, feel free just to, leave me a question right there in the chat, and I'll answer it. I'll do a quick technical analysis, whatever you want. Wait for the meeting. Markets are holding these new lower levels for the day, intraday. Let's see what Powell is going to do to us. So what happened? What's going on? are holding an uptrend here. Going into a wedge. Okay, here's our wedge. What's going to happen? It's a pennant. It's going to either break out to the top or fail. Now we are getting higher lows, but we're keeping higher or lower highs. But the support's right here, but if we want to show our lower highs, it would be right here like this. See that? Here we go. Something's going to give right here. We're going to have to break out of that channel. Break out of that channel and pop. You're gonna pop or break. Like it's breaking up. It's gonna pop. There we go. It's gonna break the high. Here's the high of day right here. Well, not high of day, but high out of this channel. We'll have to see what happens. I think Powell should be speaking now. Look, the market's coming up. Okay, let's take a look.
Yes, you want. He's staying.
You better stick around. We're just about 6 minutes away from hearing from the Fed chair himself. Jay Powell's press conference begins at 2:30. We'll take you there live as soon as it starts.
6 minutes
There's
away.
more of our CNBC special, The Fed Decision, after the break.
Oh, they're breaking all the time. So we'll keep waiting. See if we can find something else. So the stocks are starting to pop up. Look at that. There we go. Broke out of the channel. There you have it. How about that? Now this red line, by the way, is the bottom of a downtrend. Okay, I'll show you here on a daily chart. See that? So it's just, this is a daily chart. It's trying to hold the low end of this downtrend range. So we'll have to see what that does, guys. Back to the 1 minute candles. Let's see what's going on here. What's going on here? So Fed minute, we gotta wait 5 minutes for the Fed. Stocks are making a rebound. What's gonna happen? Let's watch and find out live. Okay guys, we are ready to rock and roll. Jerome Powell's about to speak anytime soon. We're just waiting for him. See what he's going to say. We're going to watch that live with you guys. That's what we're going to do. Why not happen? What happened here?
Or even 50 basis.
Okay, we are waiting for Jerome Powell for his speech. Alright, let's see what they're going to show us, guys. I'm going to turn the music off.
One way or the other, you know, we borrow money because we have certain priorities, whether it's the safety
Fed's
net
coming
or
out
the
any
40
minute.
or whatever. But you can't
Assuming
deny
he's on time. He
the
usually is.
arithmetic economic reality that if we're going to be structurally
we broke out of
borrowing
this
more in the
trend here.
future, then that all else equal means real rates have to be
Even
higher.
in a recession, I mean, this is the, some people say it's not going to be different this time. Supply never drives things in the long run.
They will come down in a recession, but will we hit the zero lower bound, which is a fancy economist's way of saying zero interest rate, and stay there for 7 years again? I really doubt it.
Yeah, I think that was a generational matter. I really do. I think it was a once in a generation.
I think it was a post-financial crisis matter.
Yes, yes.
Remember, like the Kenneth Rogoff, Carmen Reinhart,
Dropping back down the markets.
debts. They always told us that we've been through these crises before, and they take 7 years to basically work their way through. Well, it's been actually about 10, 12 years, right? So a lot of the low rates that we went through in the pre-pandemic period, we're really just working through all the deleveraging post-crisis. It's all gone now.
We've got a few seconds. What are you going to be listening to from Powell?
I think the big thing I'm going to be looking for is where does he put the inflection on where he is with respect to risks. We know that inflation numbers are a bit better than the last time he spoke. The growth numbers are a bit stronger than the way he spoke. Which does he worry about more? My gut sense is that he's going to basically ratify the view that unless the numbers go in a very adverse direction, they're done. Secondly, I want to see whether he associates himself with that very hawkish view on rates next year, or whether he disassociates himself.
Here he is, guys.
Thank you, Greg. Focused on our dual mandate to promote
Here's a
maximum
spy.
employment and
Spy
stable
is
prices for the American
doing pretty
people.
good.
We understand the hardship that high inflation is causing, and we remain
Wow.
strongly committed
What a
to
takeoff,
bringing
huh? Look at that,
inflation
like a
back
spaceship.
down to our 2% goal.
QQQ.
Price stability is the
Wow, look at
responsibility
that.
of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will
Well, I'm
not
glad
achieve
I
a
didn't short
sustained
that one.
period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points.
We're now above
and have
VWAP.
continued to reduce our securities holdings at a brisk pace. We've covered a
Look
lot
at
of
the SPY up
ground,
here.
and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate.
Here's the SPY. 1 minute
Our decisions
chart.
will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations.
SPY is ripping. Here's the daily chart right here.
Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised
Daily
up their
chart right
assessments
here.
of real GDP growth, with the median for
Really
this year
looking
now
strong.
at 2.1%.
That's the SPY.
Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%. Based on the Consumer Price Index, or CPI, and other data, we estimate that total PCE prices rose 3.4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. In light of how far we have come in tightening policy, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by a half percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal child care funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings.
Looking for this
and
to
we
break
say
down
we're
right
committed
here.
to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2%.
Doesn't want to go, does it?
But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this
Broke
time
down. We got our short.
That stance
Got
of
our
monetary
short
policy
trade.
that we're seeking. If you looked at the SEP, as you obviously will have
Okay,
done,
well,
you will
we
see that
can-
the majority of participants believe that it is more likely than not
I sold that at
we will-
18.71.
that it will be appropriate for us to raise rates one more time.
Okay.
in the two remaining
That was a
meetings
nice
this
short
year.
scalp.
Others believe that we have
Did go to-
already
I
reached
thought,
that. So it's
let's
something
see.
where we're not making a decision by deciding
two, three, four.
about that
Just got an
question,
extra.
by deciding to just
Okay.
maintain the rate and await further data.
So right now, it's still an open question about sufficiently restrictive. You're not
Look
saying
at that.
today
Here's the
that we've
SPY.
reached this level.
We're
Broke
not saying-
down and
no,
pushed right
no,
back up.
Clearly,
So
we were
there's
what we decided to do is maintain the
support
policy
here.
rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and then we've seen progress, and we welcome that. But we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need a policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for some
10-year
time.
yield is at 4.33 right now.
Remember that of course, the SEP is not a plan that is
dropping
negotiated
slightly.
or discussed really as a plan. It's accumulation really, and what you see are the medians. It's accumulation of individual forecasts from 19 people.
Relative strength
and
of
what
the
you're seeing
dollar
are the
rose
medians.
slightly
So
to
I wouldn't wanna,
104.90.
bestow upon it the idea that that's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected.
Got a couple
stronger
short
than
trades
everyone
in here.
expected. And so what you're seeing is
second
this is
one
what
took a
people
little
believe
longer.
as of now will
6
be
minutes, but
appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that. People were just stating their positions. And really what people are saying is, let's see how the data come in. You know, we want to see, what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2
Tesla's
mandate variables,
continuing to
and
hold
that's
itself
that's the progress that we
nicely.
want to see. But I
Take a
think
look,
people,
guys.
they want to be convinced.
Tesla.
They want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
Boy, this low candle really helped me out there.
I know
on that
nothing has
little
been decided yet, but what would one more hike
scowl.
at the end of the
So
year do to
interesting.
the
I mean,
economy
we're
or to
holding this
inflation?
area here.
And on the other side, what would no hike do, if you could sort of game that out for us?
So we're definitely holding some support right
you
here.
can make the argument that one hike one way or the other won't matter, but for us, we're trying. Obviously as a group,
443,
it's a pretty tight cluster of where we think that policy stance might be. But we're always going to be learning from data. We've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it. As we've gotten closer to it, we've slowed the pace at which we've moved. I think that was appropriate.
And we're definitely finding
now that we're
support
getting
here.
closer, we have the ability
So
to
what
proceed
was
carefully.
resistance here, up here, which was resistance, now became support over here.
Steve Leachman, CNBC. Mr. Chairman, I want to return to
And it's
Colby's
that big
question here.
golfer's bar here that switched it around.
What is it saying about the committee's
So
view
that's
of
interesting. We're
the
still on this uptrend. Let me draw a
inflation
quick little line
dynamic
here
in
for
the
you guys.
economy? That you achieve the
still
same
holding that.
forecast inflation rate for
We
next
have a
year,
little bit of something here
but
going
need
on.
another half
So
a
let's
point
just
of the
draw that
funds
and see
rate
what's
on it. Does it
happening
tell
here.
you that Does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is, if you're going to project a funds rate above
wedge
the
again.
longer
Let's see what
run rate
happens here
for
with this
4
wedge.
years in a row, at what point do we start to think, hey, maybe
It's going
the
to break
longer rate
down or
of
it's going to
rate
pop
is
up.
actually higher?
So,
Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've
Daily
seen
chart right here.
inflation be more persistent over the course of the past year, but I wouldn't say that's something
Breaking
that's
below.
appeared in the recent data. It's more about
The 1 minute
stronger
time
economic
frame we're on.
activity, I would say. So if I had to
Nice, look
attribute
at
one
that.
thing, again,
Okay.
we're picking
Wow.
medians here and trying to attribute one explanation, but I think
Broke down.
broadly, stronger
Below the
economic
wedge.
activity
There we go.
means rates, we have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate
That
can
would've
be,
been a nice scalp.
we know
Right
it by
here.
its works. We
From
only
here
know it by
to
its
down
works.
to here.
Really. We can't. The models and that we use. You ultimately you only know when you get there, and by the way the
So,
economy reacts. And again, that's another reason why we're
down here we
moving
had
carefully
support.
now, because.
So I
you know,
wonder if
there are
that's going to
lags
become
here.
new support
So
again, where we're losing our support
it
up
may,
here that we
it
had.
may of course be
and it's
that,
going to
that
come back down here.
that the
So
neutral rate has
let's
risen.
watch this
You
and
do
see what's
see
happening
people-
as Powell continues
You don't
to
see the
talk.
median moving,
He's
but you do
crashing
see
the
people
market.
raising their estimates of the neutral rate. And it's certainly plausible that the neutral rate is higher than the longer run
Apple's
rate.
down
Remember, what we write
1%.
down in the SEP is the longer run rate. It is certainly possible that
Microsoft's down
that the neutral rate
1.25%.
at this moment is higher than that.
Intel's
And,
down 3.25%.
That's part of the explanation for why the economy has been more resilient than expected.
Howard
AMD's
Scheiber,
holding
Reuters.
good
Thank you.
at 102.
You've said several times that the economy needed a period of below-trend growth to get inflation. consistently
AMD
back
is
to
holding
2%.
strong.
You kind of get
Take a
that
look
in
at AMD real
2024
quick.
a little bit. 1.5% is just a touch below
Where were
what's
we
the
here?
estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's
Wow.
necessary to achieve this?
Yes, of course, it is a.
did break.
it is a
Here's the
good
daily
thing
chart.
that we've seen now
They popped
meaningful
out of this
rebalancing
downtrend
in
they
the
were
labor
in.
market without
That's
an
impressive.
increase in unemployment. And
Go
that's
back to
because
SPY.
we're seeing that rebalancing in other places, in, for example, job openings. And
Right,
in,
so it broke out of this
the
wedge.
jobs worker gap. You're also seeing supply side things. So that's happening. I would say
They're gonna
though,
regain
we still,
support
I
down
still
here.
think, and I think broadly, people still think that there'll have to be some softening in the labor market that can come through more supply, as we've seen as well. Also, remember the natural rate we think is
Already broke
coming
below
down,
support here, look.
which is a supply side thing, so that the gap between
Wow.
any given unemployment rate that's lower than that,
That really
and
is
the
breaking
natural
down.
rate comes down. That's a way for supply. That's a way for the labor market to achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't see a
reach
big
a low base
increase in unemployment. We do see an increase, and but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing is progress without higher unemployment for now.
So just to boil that down for a second, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome. That there was
Tesla's
a path
dropping too right now.
really to a soft landing. I've thought that, and I've said that since we lifted off. It's also
Tesla.
possible that the path has narrowed and it's widened. Apparently, ultimately, this may be decided by factors that are outside our control at the end of the day. But
Go back
I do
to
think
SPY.
I do think it's possible, and I also think this is why we're in a position to move carefully again. That we will restore price stability. We know that we have to do that, and we know the public depends on us doing that. And we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think, that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy?
So I'd like to see that
while
pop real
keeping
quick.
policy settings sufficiently restrictive.
I mean, yes, we understand that it's a real rate that will matter and that needs to be sufficiently restrictive.
Just went long on the cues.
Again, I would say
on the
sufficiently
TQQQ.
restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates. And so what are we seeing? We're seeing, through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policies work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing we think that is working. And I think as we've said, we want to reach that. We want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing enough data that you feel like, yes, okay, this feels like we can for now decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say if we get to that level. And then the question is, how long do you stay at that level? And that's a whole other set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet. That's the stage we're at, though.
But it looks like because there was an across-the-board drop in the core PCE projection, core PCE inflation projection for this year, and even then it seems possible that core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously has said things to the effect of next year, as we see inflation kind of, again, to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah. So as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy.
All right, so the market's dropped back down
time
near the
will
lows.
come at some point, and I'm not saying when, that it's appropriate
Trading
to cut.
back here in
Part
this
of that
range
may
again,
be that real rates
which
are
was over
rising
here.
because inflation is coming down. Part of
So-
it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead.
This here seems to be
estimates of what
support
that might
right
be.
down here.
And, there's so much uncertainty around that. When we, in the moment, we'll do what we think
A
makes sense.
stronger
no one will look
support,
back at
I would
this
have
and
to say, would
hey,
be
we
we
made a
have to get
plan.
these thicker
It's not like that
candles
at all.
over here.
These are estimates made a year in
These
advance
wicks
that are highly
show-
uncertain.
We can break down a little bit, definitely to there. Bottom of all those wicks, so that's support right now.
Thanks so much, Chair Powell. Neil Irwin with Axios.
Support.
I wonder,
We're
how do you
gonna
think about the
make
question
this
of whether the strong
green.
GDP growth we've been seeing is driven by excess demand versus supply side
There's
factors,
support.
productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is the
Bouncing
level
right
of
off the support line here.
GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it
stable in
threatens
here.
one or both of those.
Let's see what happens.
Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking.
And your yields coming down a little bit.
Very real possibility of a government
4.344.
shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed?
$90.27 a barrel.
There is a long list, and you hit some of them, but it's
relative
it's
strength
the
of the
strike,
dollar
it's
has risen
government
back to
shutdown,
105.07.
resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at, and so what we try to do
Here
is
we
assess
go.
all of them and
Broke below
handicap
support.
all of them. Ultimately, though, there's so much uncertainty around these things. To start with the strike,
Broke
first
below
of all,
support.
we absolutely don't comment on the strike, as we have
Let's
no
hope that
view
this
on
this
the
support
strike
doesn't
one way or
become
the other. But
resistance.
we do have to make an
This support
assessment
line's going to come even
of its
lower.
economic effects to do our jobs. So, the thing
Here we
about it
go.
is
It
so
should lay
uncertain.
above
It will
support.
depend. The economic effects,
Well,
it could
it's right on
affect.
support.
We've looked back at history. It could affect economic output,
That could
higher
have been a nice little
inflation.
scalp, maybe.
But that's really going to depend on how broad it is and how long it's sustained
Actually-
for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain, and we'll be learning, I think, over the course of the next intermeeting period.
Nice.
Much more about that. And the same is true for
What
the
was I
others.
saying about that being a
I don't know if
scalp?
you mentioned shutdown. I think
Nice
of all of
little
these as
scalp
being on
trade
the list.
could have been right
We
there.
don't comment on that.
Okay.
It hasn't
Well, I can't
traditionally
catch
had
them all.
much of a macroeconomic
We're actually sitting
effect.
pretty good so far. So
Energy prices being higher, that is a significant thing.
I like to see very
energy
obvious
prices being
setups,
up can
but,
affect spending. It can affect consumer
never
over
a
time.
sure thing.
A sustained period of higher energy prices
Powell
can affect
crashing the
consumer
market.
expectations about inflation. We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Craig Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime age labor force participation moving up where people can add skills. Workers want to work. We have a boom in manufacturing construction. We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good for the Fed's longer run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price
Market's
stability,
holding
inflation
support,
comes back,
testing support
you go
again.
through- you can have a long period
Testing that
where,
base.
The economy is just very uncertain, and it'll affect growth, it'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor
breaking
market,
the base.
inflation
There we
coming
go.
down,
Is it just gonna
without
end up being a
seeing,
wick?
an important
We'll have to see. We
large
just broke
increase
support.
in unemployment, which has been typical of other tightening cycles.
Right here, we just broke support.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of
the lows are
what
right
some
around
economists
here.
are calling the low-hanging fruit, such as the unwinding of supply chain snarls and
Let's
other
see what
pandemic
happens.
disruptions, or is it more a broad inflation,
They're
disinflationary
going to break the all-time low
that
for
involves
today.
most goods and services across the economy? Thank you.
So if I understood your question, I would say
We're
it
going to
this way.
find out. There
I
it
think we
goes.
knew
Back up onto
from the
support.
time- from
Right
before
on
when we lived
support.
there, certainly by the time we lived, we knew that bringing inflation back down was going to take.
Here we go.
As I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the
a
response.
support
So that
zone here.
unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Michael McKee from Bloomberg Television and Radio. In June, you forecast a 5.6% year-end median Fed funds rate, and since then, you've more than doubled your growth forecast. You lowered your unemployment forecast significantly. So what would justify that last move? Because the median forecast is for lower inflation. And given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well,
Here we go.
forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected, and that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really
We definitely
because of
got
what we've been
something
seeing
going on
the
in
labor
this
market. We've
range
seen
here.
More and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last three readings are very, very good readings. It's only three readings. We were well aware that we need to see more than three readings. But if you look at June, July, and August, you're looking at really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the three buckets. Headline inflation, of course, has come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult and
this
these are
range
highly
again.
uncertain forecasts, but these are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Losing strength.
Given the forecast
There's our green line.
that you have, what justified not moving
We're not
today?
danger zone
and
again.
what could justify moving in the future if you think inflation is
Here we
coming
go.
down? In other words, why did you leave that extra dot
Breaking
in?
support.
Well, I think we have come very far, very fast in the rate increases that we've made. And I think it was important at the beginning that we moved
Now is
quickly, and
this-
we did.
which
And
was support
I think
might
as we get
turn
closer
into
to
resistance.
the rate that we think
We
the
could have a new
stance of
support
monetary
line down
policy
here.
we think is appropriate to
So let's see
bring
what
inflation
happens.
down to 2% over time.
Let the clock
the
roll.
risks become more two-sided, and the risk of
Drop it
over
all,
tightening and the
Powell's
risk
crashing the market.
of under tightening becomes more equal. And I think the natural common sense thing to do is as you approach that, you move a little more slowly as you get closer to it, and that's what we're doing. So
Could bounce
we're-
up here to there.
We're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge and that by the time you meet in November that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was it? What factors?
The base factors.
Base factors. Okay. So on that,
I don't know if we like that question or not.
Right, you can look at just monthly readings and see what the increase was from the prior month. So you're right. When you go back 3, 6, and 12 months, you get base factors, but we can adjust for that. In terms of not getting data, again, we don't.
Could have been.
We don't comment
I
on
chose not
government
to, but that
shutdowns.
could have been a nice scalpel.
It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility. Yes, I mean, if you're looking, if we can tell how much inflation has gone up in a given month, right? And that's what we're looking at. And month by month, what's the reading?
We broke that range of danger.
I think what we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12 months.
Holding down.
But I think
here,
in this
so
situation where it looks like
yeah.
we've had a bit of a turn in inflation
become
starting in
resistance
June,
now.
we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation is actually rising.
Right. So energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that you know, if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation, things like that. That's just things we have to monitor. So.
On the consumer, they're putting more and more of this on their credit card. The consumer seeing record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So, to finish my prior thought, I was saying that's why we tend to look through energy.
It's a much
moves
longer speech, so there we go. It's
that we
breaking
can
down
see
more.
as short-term volatility.
breaking
in terms
down.
of consumer credit, of course, we watch that carefully. Consumer distress.
We can get rid of this
measures
support line. That's no longer
were at
support.
historic lows quite recently. During and after the
Go to the
pandemic,
depths.
they're now moving back up to normal. We're watching that carefully, but at this point, these readings are not at troublingly high levels. They're just kind of moving back up to what was typical in the pre-pandemic era.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks, and how much of it can be attributed to macro explanations and how much to technical factors?
So you're right. Rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things, either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. But the common explanations that you hear in the markets kind of make sense.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing. You've said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
To the depths.
So on the supply point,
now
of course,
touching
supply
this-
is very important over time.
It's now breaking down to the bottom of this,
house prices
down
and
just a very
for that
big
matter,
support
rents.
here.
And
Just this
supply
red
is
line,
kind
it
of
broke
structurally
downtrend
constrained.
range.
But in terms of
So
where
that's,
inflation is going in the near
weak.
term, though, as you obviously know, a lot
Not
of it
looking
is
good.
leases that are running off and then being re-signed or released
I would
at a
expect
level
it to
that's
bounce up.
not
I would
as-
expect it not to
it won't
stay
be
below
that
the
much higher.
440, 95, but we'll have
A
to
year
see.
ago, it would have been much higher than it was a year before. Now it may be below or at the same level. So
What's the
as those
QQQs
leases are
doing?
rolling over, we're seeing what we
they're
expect,
also
which is
dropping
measured housing services inflation coming down.
And they're below the downtrend here.
Your second question was the lock-ins. How much is that affecting things, really?
Back to yesterday's lows.
Potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of
Interesting.
buying and then a lock-in that sort of stagnates the housing market.
I think we look at I would look at the lock-in, the idea being that people are in very low rate mortgages, and even if they want to
Go
move
back
now,
to the
it
SPY.
would be hard because the new mortgage would be so expensive. And that's explaining that's one of the explanations for what's happening broadly in the labor market. Would that play a role in
Put this on
our
a 2-minute
future
chart.
decisions in a future loosening cycle? about whether we would cut rates.
The 2-minute
No,
chart.
I don't think it would. I mean, I don't think that's.
Show the drop off.
I think we'd be looking at what the, fundamentally, what rates does the economy need? And in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road I wouldn't think so.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. Concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed-rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences in the sense that if you're a relatively wealthy household with a long fixed-rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So I guess it's fair to say that the economy's been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that spending is held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. It could just mean that the date of effect is later. It could also be that for other reasons the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We're making progress on inflation. Growth is strong, but I think by many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question, your second question was distributional, but can you be a little clearer about that?
My point there was that if you're somebody who has a long fixed-rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are living on credit cards and borrowing are going to feel that more. They are. And of course, people with lots of savings also have a much lower marginal propensity to consume, and so it's not going to affect them as much.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-income Americans. I have two questions about this. Are you going to use that data to maybe come up with a sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And and also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? I just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate